Hey everybody, it's Pete. Good morning. Welcome to today's episode of Stock Trading Pro. Today's Stock Market Live is going to discuss whether or not stocks can hold the bid this week and the price action that we're looking for the entire week. Don't forget, we have a short stock market week this week with the holiday coming up. So we're trading Monday through Friday this week, which might influence some swing trades for the week. So we got a lot to talk about. We got stocks on the bullish side of the market this week, the bearish side of the market. Stock futures are actually trading a little bit lower right now. We have two particular sectors that we're going to take a look at. One on the long side to be buying those stocks, one on the short side to be short selling those stocks. I'm also going to remind everybody about inverse ETFs because they are a big part of our Discord community right now. A lot of people making some pretty, I'm not going to say easier trades as the market's going down because a lot of people just have a better feeling of buying something to make money. So when the market goes down, those inverse ETFs go up. So I'm going to point you in the direction today of the most common ones that are in our boot camp. We're actually in the middle of a really, really exciting boot camp right now. Our coaching call last Thursday was 2 hours and 20 minutes. It was legendary and it was awesome. So I hope that you guys are inspired. We gave you the questions last Friday. Maybe you come back today and ask any other new questions that we might have had. So we're actually going to get right into it. So today's Stock Market Live, we'll get started in just 1 second. Okay, so thank you so much, everybody. You know what I think I'd like to do today? While I'm talking, if you could do me a favor, type in the stocks that you traded the most profitably last week. Maybe we'll take a look at those guys today as well. I'm curious because just to give you a little bit of context, the stock market last week and buying stocks last week was a little bit challenging unless you were in two particular groups. And we'll just take a quick look at those right now. And those groups for last week were the XLV, the healthcare sector, and the consumer staples sector. So we're basically talking about like Costco and Walmart and Pepsi and Coke and those guys. So, but however, there's another group of stocks that we've been looking to be a buyer of probably for the last 3 or 4 months, but they haven't rallied, and that's the financials. The financials caught a little bit of a sneaky bid last week. I'm going to break down some of the stocks that I'm going to be considering and the price action that they need to get to before those stocks make their way from my tracking journal into my trading game plan. If you're new to the channel, you don't know the difference between a tracking journal and a trading game plan. A tracking journal is the ideas that you're considering, but certain type of price action in those stocks needs to happen first. So maybe you'll set an alert at that price. A really advanced thing is to set a buy stop for 100 shares at that price. By the way, I actually learned that probably in 2001. Somebody named Mike Renzulli actually was one of the managers of the office in Montvale, New Jersey when I was trading. And most traders will have a certain price that a stock needs to get up to, and they'll put an alert at that price. Mike actually taught me at that point that put 100 shares at that price so it gets into your position summary, and then you can start reading the tape. It's a pretty advanced thing to do. You have to be at your computer or at least know when you're getting filled on those orders to know how you're going to manage it. But I think it's a really good way to manage the tape without taking too much risk because you have the minimal amount of shares, whatever's comfortable for you. Now with fractional shares, we couldn't really trade fractional shares back then. Now you could do it with 10 shares if you really wanted to. Let's take a look at, see, Joseph traded Oxy. Okay, Robin as well. Hey, Robin. Good morning. Good morning, Robin, SYY. Daryl and Oxy. Let's take a look at Oxy, actually. So some of the energy stocks actually caught a bid last week, which was pretty cool. So Oxy broke out. So if we could break this down a little bit more, for me personally, this would have been the level. You can see now, again, this is one of the things we actually talked about. This was actually one of the things we talked about on our coaching call last week is what is the real price that the buyers of the stock are having a hard time pushing it through, or to say it a different way, what is the real price that sellers are holding? This is a good example because amateur technical analysts put the highs and the lows and they just leave it there without actually looking into the price action. That's not really a good way to do it. You have to look and see what is the actual price. So for me on Friday, 59.50, basically $60. So it's actually pulling back a little bit to that level. But if we add volume into the equation here, this is something important. So I'm actually going to talk about this from a mindset perspective, which we spent a lot of time on mindset yesterday on our swing trade, our weekend swing trade call. If you bought the breakout in Oxy, and let me actually keep that up on the chart right now so we can keep a look at it. So it meets all of the criteria. It finally broke out of a 6-week trading range. It closed near the highs. The sector was strong. The group was strong, and it closed on bigger volume. Here's the thing, though, and I want to bring this up in an important way. So many people mistake a trade that doesn't follow through with a bad trade. If we do our job of stacking the order flow, reading the tape, getting it near the optimal entry, reading the stocks in the sector, putting together stocks in that industry group, and the stock does exactly what we thought it needed to do in order to buy it, and we get in, and it does not follow through, that's still a good trade. It's just a trade that didn't follow through. And a lot of the people in our boot camp right now are having these revelations of the difference between I traded bad versus that's just a business expense and I'll move to the next trade to make money. So if you bought Oxy last week, that's actually a pretty good trade. I know everything in the market's trading down right now. It's a good idea. We'll see today, which actually brings me up to something else. Far too many people trade off of the levels happening at 6 o'clock in the morning. It's not the smartest thing in the world to do. If you're in a position, at least do your best to let the market open, because where it is at 7:30 in the morning is not necessarily where it's going to be at 9:30 when the market opens. It's very, very common for strong stocks to have a little bit of a weaker open, catch a bid, and then take off again. Learning how to manage those winning trades is the secret to getting paid. There's really no other way to put it. If you have an edge, if you understand how to read the tape, if you understand how to buy stocks at the right time, really, the only other thing is, can you make enough on your winners to kick out to pay for all those tiny losses that are acceptable dollar amounts? So I like this trade at Oxy. Whether or not it follows through, we'll see today. It looks like the whole stock market's trading a little bit lower now. But again, that's just getting a feel for where the market's going to open today. So I actually like that one. Let's see. Don taking a look at Walmart. My gosh, Walmart was a house on fire. Look at this. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days in a row green. 11 out of 12 days where the stock has had higher lows. That's a pretty big move. That's actually a really big move. Now, if you remember what we talked about last week, we said that there's a difference between a stock that is an absolute buy right now from a stock that is what we call a bullish echo. So you want to write this down. Actually, you know what? I'm going to bring it into the screen for you. Let me actually pull that up. And I'm going to bring, you want to snapshot this, okay? I'll give you a heads up, all right? So right here. So a bullish echo is where the stock is an obvious long. And if you don't know the terminology for long, that means a buying opportunity, but too far from the optimal entry for a new swing trade. So if you think about the ideas when you are looking to be a buyer of stock, you have day trade, swing trade, position trade, investment. You need to know what is the acceptable risk for that idea based on what you believe is the next move in that stock. So at some point, you're either going to hit your stop loss or you're going to hit your profit target, but you have to justify the risk because you think the odds of it moving in your favor are pretty good. So if we go to Walmart right now, I know it's at all-time highs, so let's factor that into the equation. If we go to the bullish moves of what's a normal move in Walmart, and let's actually go to this one right here, which basically traveled from 135 to 140. So basically $11, right? And that's probably one of the bigger bullish moves. Maybe we can go to this one here on this breakout. So we're looking at 143 up to 151. So somewhere around $10 is a normal move for Walmart. Right now we're talking about, even if you take this pullback, these two candlesticks here, and this break, 144 to 158. That's $14. So if a normal move is 10 to 12 and it's already gone 14 on the last swing trade, pushing into new all-time highs, that's a really bullish stock right now, but it's not a good swing trade right now. So as much as we just talked about before that some of these stocks in the consumer staples area, which has been very, very strong. So obviously Walmart, Costco is up in that area. Pepsi, we've been watching as well. We stay away from the terminology overbought and oversold because that tends to mess with your mind and want you to have a reversal type play. We use the phraseology that where is the optimal entry? The optimal entry tells you if I buy it at this spot, that means the odds of making enough profit on this trade are likely. So if we're talking about a swing trade, that's usually a wider stop loss based on the daily charts or average true range or some percentage. Maybe, William O'Neill does the 8% on the stop loss. Day trade's different. Day trade, that stock is still bullish, but you're managing it on those micro time frames. So we might be looking at, let's say we go back to Walmart and we drop it down to the 5-minute chart, which I know this might be foreign for a lot of people, but you're managing it on these candles here. So we're basically looking at this one, 56 to 50. So that's 30 cents. So you're talking about risking 30 cents for a day trade in a stock that's obviously bullish versus risking $3 for a stock that is well beyond the optimal entry. So the risk reward is there on a day trade if it meets certain criteria, if today's order flow matches the longer term order flow, but the risk reward for a new swing trade in Costco and Walmart and Pepsi does not make sense. So hopefully you get that language down. Bullish long versus bullish echo. The echo is kind of, if you could imagine the buying pressure and you got that one last little push, that's the echo that we're looking to day trade. We do, however, have a whole group of stocks that match that criteria. The whole reason we brought that out is because I wanted to walk you through some of the ideas on the long side. Some of them are still at reasonable places. Some of them are a little bit extended, but maybe they have like a 1 or 2 day trade in here, but nothing longer than that simply because of how far they've gone. And of course, I'm talking about stocks in the healthcare industry. So we're going to bring this back over to the daily chart. And we're going to work our way back over here to healthcare. So a couple of people typed in ABBV, and that's absolutely spectacular. This stock is one of those stocks you're probably going to want to watch with a slower moving average. Look at how long this stock has stayed above the 20-period moving average. We are talking about all the way back here in January. The stock has not closed once below that level. And again, hopefully you're a regular viewer of Stock Trading Pro and the Stock Market Lives, because we've been talking about ABBV for the better part of 2 months. If you're not, make sure you hit that subscribe button because we put out updates over the weekend. We had a new sector rotation video. You want to make sure you get those updates. So ABBV meets the criteria. It's a bullish echo, though, because now the stock is higher for 4 days in a row. Again, I want to make this clear because this gets misunderstood sometimes. We are not putting a limit on how far ABBV can go, or anytime we're talking about a stock that has bullish echo. We then, after a stock hits our initial profit target, then we switch over to something we call a profit maximizer. So you have your risk to put the trade on. You have your initial profit target that justifies the risk. Now, what if your stock travels all the way up there? It does what it normally does and hits your target. Big traders, trend traders, people that make small fortunes when they're trading, they are okay with risking unrealized profits, so the distance between your entry and your initial profit target, in exchange for a much bigger move. Now, here's the thing, and Jesse Livermore talks about it. Every professional trader that's been around for a while talks about it, which is a pullback that you're okay with letting unrealized gains pull back. So allowing a small gain at risk in exchange for a much bigger gain. So think about what's the risk on that trade. Prior to the trade, you're okay with losing money because that's the stop loss, right? In exchange for what you could potentially make to justify the trade. So you started the trade out saying, I'm okay with losing this because it's a good idea, but if it follows through, that's the initial profit target. So now you have a trade that moved in your favor. Again, we'll keep talking about ABBV here, which also, you can see up here. I want to give you a few in this group here. ABBV, Pfizer, which is also been pretty strong. It's got to get through this level here. UNH, Lilly. These are probably the biggest ones, and Amgen as well. So I just wanted to give you a list of stocks. So the big thing, though, I want to get across here, which is very, very important. So we just talked about when you put the trade on, you're okay with taking some risk in exchange for the profit. Now, what I'm talking about now is mindset. It's not only mindset, but it's a trading concept that you absolutely need to get your head around. And it doesn't matter if you're day trading, swing trading, investing, position trading. And quite honestly, investors are probably better at this than active traders because investors allow stocks to fluctuate for a really long period of time before they eventually do what they planned or hoped, whatever word you want to think about when somebody buys a stock as an investment. If we're okay with taking a risk down to a negative number when the trade is on, I got a question though. Why are we not okay with a small profit turning into, at worst, zero in exchange for a much bigger gain. So just to give you some numbers, if let's say you risk $1 to make 3, we're now risking that 3 back to 0 in exchange for that 3 turning into 9. That's a big difference over the days, weeks, months, and years if you understand how to read the order flow, how to read the conditions of when you should be switching over. We actually have 2 different types of profit maximizers, and this is very important for you to understand. And we're getting a lot of nice feedback about when I use analogies about driving and trading. So if you could imagine the trade that you're in and or the conditions that you're in and which type of profit maximizer you choose to use. Are you in a tougher market condition, which we absolutely had last week? There's not even a question about that. Last week's market condition was very, very challenging. We started out the week with a well bid candlestick coming off of this swing low and went well bid and closed near the highs. Monday looked great. Then Tuesday came in with a bearish U-turn. So again, if you're not familiar with our language, a bearish U-turn means it traded above the previous day, reversed back down, closed below the open, which makes it a red candlestick, and closed below the previous day's high. It's a momentum reversal candle. So what we just talked about is a bearish U-turn. I'm going to show you one more time on the charts. So Tuesday traded into a bearish U-turn where this candle traded above the previous day, came back down, closed below the open, and closed below the previous high. So if you think about those 2 days of trading, Monday was great from a bullish perspective. We went well bid. We had higher highs, higher lows, closed near the highs. Monday looked pretty darn good, especially coming off of that run that we had for about 3 weeks. So heading into Tuesday, every reason in the world to expect a follow through on Tuesday. But we actually ended up, not only was it a bearish U-turn, but it was a bearish engulfing candlestick. It took out the high and it took out the low. So Monday to Tuesday, we had a lot of people pulling their hair out of their heads. I definitely got some more gray hair on Tuesday. It didn't follow through the way that we scripted it. So the point that I'm bringing back to that is if you are good and understand the significance of getting out of losing trades where you're supposed to, and again, we talked about that in this morning's email, the next stage is understanding what kind of profit objective, what kind of profit maximizer you should be using. When the market is challenging and less than obvious, that's where we really shift over into what we might call a momentum profit maximizer, where the first sign of the stock that is bullish slows down, we'd be a little bit more aggressive to move up a profitable trailing stop loss because we were going fast and now we're in stop and go traffic. So we have to adjust the profit that we're willing to take on the trade because of the current conditions. So now we shift over into Wednesday, Thursday, and Friday. We went from this bearish engulfing candlestick to a bearish gap to basically a 3-day trading range. So what does that mean? How should you have traded last week if you were an active day trader especially, but even on the swing trading side of things? This is a lesson from last week that you need to apply today and going forward, okay? If you understand adjusting your profit maximizer to the current conditions, which the first one is a trend trading profit maximizer, and I want to show you what that looks like here. So if we're looking at this type of candle here, so if we have that kind of candle in momentum and we get what we call a melted candle, that would be a sign of moving up your trailing stop loss. So we have energy versus melted candles. So that's a big thing there. So I wanted to let you know, and this is something that a lot of people talk about, last week was tough. If you held your own, maybe made a little bit, lost a little bit last week, as an active trader, I'm not talking about long-term investing, I'm talking about last week's price action, you did a pretty darn good job, because last week was one of those weeks where we had a lot of conversations in our Discord where I spent the better part of the week saying, reduce your position size. It's the right thing to do right now. We're trading for cash flow, and that's a big conversation that we had last week, which means that because of the market conditions, because of the sector rotation, because of the way stocks were trading and breaking out and failing, or staying in a range, it didn't call for allowing unrealized gains to pull back in exchange for a bigger one, because last week we were kind of stuck in traffic and it was smarter to scale out or book those profits into momentum and then go to the next trade. So now we're facing a little bit of a different market this week, heading into the week, where we're actually now at the bottom of the, we're actually down $2 and change right now. And we can actually see that a little bit cleaner in the futures markets. We're actually down 27 at this point. So the big level that I'm looking at right now is here, this 441.63, and you can see it over here in the top right hand corner, or maybe you can't see it. It's 441.63. So that's the level that I'm watching today. So this is what you need to write down. If the S&P 500, if the SPY ETF somehow opens lower and gets below that level, and this is a big thing. So remember, if this, then I plan to do this. If we trade below that and the weekly chart goes well offered again, where again, you can see this here, energy candlestick, melted candlestick. That's a circumstance where you would look to move up a trailing stop. And now we went well offered. So you can see on the weekly chart, we're holding that level. Now on the daily chart, we need to hold that level. If the weekly chart of the SPY goes well offered, which that would look like this, lower highs and lower lows. And if the daily chart does the same thing, where this candle now, which is a melted candle, gives us red energy candlesticks, which would be bearish, and we somehow get below this level, there's two things you need to do this week. Number one, if the price action doesn't make sense to you, step aside. You don't have to trade. I said that probably 1,000 times this week inside of our community, that if you want to get my experience, I'm telling you, there's some kind of market conditions where it's just not prudent to take risk, because at best you're going to be a break even, and break even trades make break even traders. So that means that you need to go up the power pyramid a little bit and find the individual groups that are either outshining the rest of the market or stay in cash. If you decide to trade, those are more momentum type trades where we're looking to book profits quicker using a momentum profit maximizer. Now, again, last week, and this is really why I'm bringing this whole piece together. Last week, the energy stocks caught a bid. The healthcare stocks remain strong, and the consumer staple stocks remain strong. But the sexiest group out of everything was the weakest stock, which is technology. Technology, when technology lights it up, it kind of carries the entire market, especially when it's the large cap tech stocks. And we did not have that last week. So if we take a look at the XLK, which is the sector for technology, we had a bearish gap, and we've already gone below that key level that we're trying to keep an eye on in the SPY for it to stay above. So if you know anything about Dow theory, it's something that we talk a lot about. It's in my program. It's in the home study course. Dow theory was written, I believe, 100 years ago, maybe 90 years ago, something like that. The theory behind it basically says that the indices must confirm each other, and if they do, you can expect follow-through. I'm paraphrasing a much bigger book. So right now, the S&P 500 is kind of holding the bid, and it's fighting that move down that technology stocks is making. If the S&P 500, and more specifically, which Dilip in our community brought up last week, the large cap stocks that have a strong grip on the S&P 500, like the Apple, the Tesla, and all those larger stocks, if those stocks start to roll over and the S&P 500 in the context of Dow theory plays true, we might see a faster move to the downside if that happens. Now, if that happens, you need to be prepared. There's two ways to be prepared. Make sure you understand what your risk is and stick to it. Number two, learn the inverse ETFs if you want to hold positions and hedge. So again, remember, everything we're talking about here is for educational purposes. It's up to you to make the final decision, but I want to show you a way that I hedge, which is using inverse ETFs. So if I own stocks and it looks like the market's going down, but I want to maintain those positions, a hedge is something in the opposite direction. So if the market goes down, your hedge value goes up. So the way I'd be looking to hedge is I would be looking at either the SDS to go higher, because when this goes higher, the market goes down. So that's one way of hedging. You can see it's actually up this morning, or the SQQQ. Those are two ways that I'd be looking to hedge. So again, the context of this hedge is if I still like my position, I still like my unrealized gains. I think it's just got to withstand a pause or a pullback in exchange for that next move higher. And I don't want to give up my position. Remember, this is a profitable trade, not a trade that's a negative trade. One way of hedging that would be the inverse ETFs. Another way, obviously, would be buying puts. Now, puts are a little bit tricky to use as a hedge simply because they expire. So you need those puts to actually hold their value in the time frame that you need to hold that idea. A different way to hedge, which I think is a little bit easier, quite honestly, and again, easy is relative for everybody, is understanding that the biggest traders that I've ever traded with, and this is proven throughout history, that you buy strong stocks and you short sell weak stocks. So what you'd be looking to do right now, let's say you're long some of these healthcare stocks that I just gave you the list of. Let's say that you might be long some of these consumer staple stocks like Walmart, Costco, Pepsi, Coke, any one of those kind of ideas, right? PG, PGR, any one of those. You then would look to be short selling, maybe not dollar for dollar, but short selling stocks that are already weak. So if the market goes down, your strong stocks should go down a little bit, but they should hold the bid because there's buying under there. There's bullish order flow. But if the overall market goes down in the manner that we just explained, weak stocks should go down faster. So your short sale hedge, stocks you're betting will go down because they're already going down, will go down faster. So you'll make money on the hedge while you lose a little bit less and protect those gains on the strong stocks that have unrealized profits at this point. So what I want you to do right now is just stick around for just 1 second. I'm going to walk through some stocks in the technology area that are already weak that could be used as a hedge, as a short sale against those stocks that you want to hold that have been bought. So I'm going to go over to the charts and we're just going to take a look at some of those ideas. And as I pointed out, they're in the technology area of the market, which right now is Riot. Again, this is a Bitcoin mining stock, but obviously bearish. AFRM, ASAN, Coin, again, another Bitcoin related stock. NVIDIA, also pointing to the downside. DOCN, DDOG, and APPS, just to give you an idea. So what I'm actually going to do here as well, I have a bigger list of stocks. It looks like the list is a lot, actually. I'm going to post the link in here right now. And this, if you're looking to expand what you do and think about short selling stocks as a hedge against better positions that you own, stocks that you bought that you're looking to hold, the list that I just put in there, you click on that, it'll open up FinViz. It'll give you ideas of stocks that are already bearish. So again, I just want to explain this concept one more time. We talked about initial profit target. We talked about some stocks to buy. We talked about healthcare, and we talked about consumer staples. Now we're talking about stocks that are already weak. So what we'd be looking to do is, if we have unrealized profits on stocks that we bought, the best stocks to buy now from last week, now heading into this week, and we want to maintain those winning trades, you would short sell stocks that you expect to go down while you would be holding your winning trades. It's a look. I mean, we've all heard it's hedge fund. Hedge is hedging, right? A lot of them do that. That's exactly what happens. That's where the term hedge fund comes from. It was really originally around defining risk, not so much the superstar hedge fund managers that we all know today, like Kathy Wood and those kind of people. But hedge fund is literally doing this and created to do this to manage the downside. So what we're talking about today is a pretty advanced trading concept that you as an individual trader can take advantage of. It's just be smart about how you do it. Really do your game planning out and understand the possibilities of what happens on a short sale. Understand when you would close that short sale as the hedge. This is the big thing. So let's say, for argument's sake, and let's actually use Costco, not Costco. Let's use Walmart as an example. So let's say that you like Walmart at all-time highs, but we feel that Walmart is now a bullish echo that has expanded too far. So we're probably looking at Walmart over the next couple of days, maybe pulling back somewhere in that area, right? You know what? Let's actually do this in a different way. Let me get these guys off the screen. Let me get this off the screen. Let me get this off the screen. Now, something you've probably seen us do quite a bit is we use Fibonacci retracements. So here's the full Monty on how we're going to use this. So this is the last move. Now, you know that we usually talk about the 50% level being the level where a stock will typically pull back, and that's the last line in the sand that I'll be looking to buy it. But because Walmart is strong, I don't think it's going to get all the way back to this 149 level. So we're probably going to end up somewhere between this 152 and 154 level, which might not seem like a giant move, but that could pull back for a couple of days. So here's the trade scenario from start to finish. We want to maintain the long position, the position that we bought in Walmart, but we want to hedge the trade so we can hold it looking for it to take off again. So we'd be looking at weak stocks to short sell. Now, here's the trade management. When do you cover your hedge? So when you get out of a short sale, you're covering that and you're buying it back. Well, if we know now that the furthest we're looking for Walmart to pull back is the 142 area, if Walmart pulls back to 142 and gives us a bullish U-turn, which is the opposite, it's a momentum reversal to the upside. So let's say it goes from 152, not 142, 158 last week down to 152. So let's say it pulls back for 2 days, maybe 3 days. So let's say Wednesday comes around and Wednesday trades into a bullish U-turn. So it looks like Walmart pulled back and looking like it's ready to go back up. That's when you cover the hedge, get out of that position, and now you let Walmart head back to the upside if that's what price action actually unfolds. We just talked about a really advanced topic. I gave you a bunch of ideas on the bullish side in those two sectors. I want to finish up with, and the short side, obviously on the tech side, but I want to talk about financials right now because the story has changed a little bit with the inverted yield curve. You can clearly see here that the XLF is kind of in the middle of nowhere, but last week the XLF traded down. You can see melted candle, melted candle, melted candle. This bottoming tail led to a well-bid candlestick. So what I'm watching for now this week on the weekly charts, we are looking for this bottoming tail to now go well bid. So we're looking for this type of candle here in the financials. If we get that in the financials this week, we have a different story unfolding now, and we might finally be able to start watching financial stocks for buying opportunities. If that ends up coming into play, then I'm going to be looking at Goldman Sachs. I'm going to be looking at Morgan Stanley. I'm going to be looking at Citigroup, and I'm going to be looking at JP Morgan. Those are the group of stocks. Now, I can already hear some people sending messages saying, but why are you buying the bottom? They're all near the lows. I didn't say I was buying them this week. I said I need for this week to play itself out. If that plays itself out, where financial stocks and interest rate conversation starts to come back into play, and we don't have that whole inverted yield curve scenario, these guys might finally loosen the reins and start to see a move back to the upside. And maybe we can get a trade out of that for 2022, quite honestly, because that's a big story playing out this year with the interest rates. So again, we're mapping out stuff in the tracking journal and game planning for what we need to see over the next week. If the XLF and that list of 4 to 5 financial stocks that I just gave you follow through that momentum reversal with bullish order flow this week, which means a higher high and a higher low on the weekly chart, then we could be getting interesting in the financial stocks, and we'll shift out of the stocks that we're in right now if they're not in play anymore, and we're already giving ourselves ideas for the following week, which would be next week. So that's kind of cool when you start to really put these pieces together. So that's what makes trading fun to me, because it's not necessarily everything that's going on right now. You're like, okay, this is cool. We can trade these back and forth. We can hedge. We can buy. We can short sell, all that kind of thing. Every day we can go in looking for the best stocks to buy now. But what if we stay on top of the rotation? Again, something that we give you every day in the community. What if we stay on top of the rotation and we see these other stocks unfolding in a way that they start to work their way up the list from a negative number, where they go from number, what's going on there? Software is popping up. Where they go from 7 to 6 to 5 to 4, and all of a sudden this week ends and they're up in the top 3. That would have me starting to look now at these stocks again, because we'd be breaking this longer term move to the downside, and then we'd actually have something else to pay attention to. So again, that's exactly right. That's exactly right. So nice job on that, Lewis. Exactly. That would end up being a two-step trade. So we start to work a new position looking for follow-through. So again, if you're new to the channel, please do me a favor. Make sure you hit subscribe. But I want to give you a little bit of a suggestion as well. Watch what we talked about again today sometime and take notes. Take notes. And if you have follow-up questions, leave those comments below in the video, simply because I want you to have a little bit of clarity on what we talked about. We talked about an advanced topic today, but it's a way that professional traders manage the downside on winning trades. And that's a really big topic, because a lot of people want to manage, they don't want to get out of losing trades, but you should. If it's not working and you decided you had a stop loss, get out. We're talking about something different here. We're talking about holding a winning position in an expected down move by hedging against it. It's a pretty advanced topic. So again, you could do it with ETFs, you could do it with puts, or you could do it with straight up short sales. So do your own due diligence, learn how to understand the short side of the market. Hopefully today was a little bit of a starter for you. And if you have any follow-up questions, put those in the comments below the video. All right, I have to head out, everybody. I got to get ready for my game plan meeting, which starts at 8:30. Have an awesome day. Make sure you subscribe. Hit that like button if we gave you some stuff that you found valuable today. Okay, have an awesome day, everybody. I'll speak to you soon.